Good afternoon and welcome to the Sylvania Platinum Limited Interim Results Investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Jaco Prinsloo. Good afternoon to you, sir.
Good afternoon, Alex, and good afternoon to everyone online. And thanks for the opportunity to take you through our results for the past 6 months. Myself and Ronel Bosman, our CFO, will take you through the highlights of this period. I think maybe just also to welcome Ronel officially. It's our first official reporting period after taking over as CFO on the 1st of December from Luann, who stepped down at that time. But Ronel is not new to the company. She's been with us for more than 5 years already in the senior finance positions, so more than able to take us through the financial results. So we'll take you through it in a moment. Just before we get into the detail of the presentation, please just take note of the standard disclaimer, and if you make any investment decisions in the company, you shouldn't make it solely on the information contained in this presentation, just as a standard. Thank you very much. Okay, so as we just briefly, I think as an overview for those of you who don't or not maybe so familiar with the company, Sylvania is a low-cost cash generative PGM and chrome producer, and we have at the moment all the revenue and profits you would see from the current presentation has been generated from our existing Sylvania Dump Operations as well as the newly commissioned Thaba JV. And we have 6 of these beneficiation plants with an SDO located on the eastern and western limb of the Bushveld complex, respectively, that treat a combination of run-of-mine characterizings and historical chrome tailings at the respective sites. And then as part of our growth profile, the Thaba JV has just been commissioned in Q1 of this financial year, and we are currently in a ramp-up phase, but I'll deal with a bit more of the Thaba JV specific progress later in the presentation. I think if we just look at the summary of the results for this first half year, as an overview, I'm very pleased to have a very strong set of production and financial results for the half year. And I'm very proud that we were able to post a 25% improvement year on year in terms of the 4E ounce production. And it's during a period where all 6 of our SDO plants have exceeded their business plan for the period, and really a remarkable performance. I think this supported by a 55% improvement in the PGM basket price, where we currently, the average reported for the period was $2,162 per ounce, have certainly assisted us to post very attractive net revenue and EBITDA figures. Our net revenue have increased 110% to almost $100 million, $99.8 million. And our adjusted EBITDA have increased to $51 million, which was a 414% year-on-year improvement. While we managed to still control our cash cost very well, in fact, our cash cost was slightly down period on period, primarily driven by the increased ounce production and bringing down our unit cost. So overall, this enabled us to still maintain a healthy cash balance, and also in line with our commitment to distribute our capital allocation to shareholders. I'm very pleased to announce that the board have approved an interim dividend of 2 pence per ordinary share that we will pay in this period, as well as an additional $2.5 million that we have allocated for share buybacks based on our evaluation and opportunity. So all in all, I think a very pleasing set of production and financial results. So I think we are not just focusing on the financial and production per se, but it's also important for us that we return value to our employees and the communities where we operate. And to that extent, I'm very proud of our safety performance as always. I think maybe just highlighting some of the key features, I'm very happy that we managed to maintain our fatality-free record since the inception of the first operation almost 18 years ago now. And then we also have a remarkable achievement. Durban was still 13 years lost time injury-free and Doornbos, Lennox, and Mooinooi all injury-free for 4, 3, and 1 year respectively. So certainly a remarkable and an industry-leading performance from safety on these operations. If we focus for a moment just on the operations and what enabled that 25% PGM production increase for the past 6 months, or the first half of the year, we were fortunate that we've managed to increase our PGM feed tons by about 9%, and that was on the back of improved stability and utilization on all our Sylvania Dump Operations, while the Thaba operation is still ramping up. In combination with the higher tons, we also carried on the momentum from the higher feed grades, that we saw from about the latter half of the previous financial year, and that carried on, and we had a 10% higher PGM feed grade. And primarily the contributors there is higher grade material received from the host mine at Tweefontein, Mooinooi, and our Lesedi projects. As you can see, the contributions in the bars at the bottom. And then finally, also very pleasing that the recovery efficiency has increased to 3%. It's quite a bit improvement on our long-term outlook of about 54 to 56% recovery. And it's very pleasing that all three of the levers that we are able to pull to increase production in terms of tons, grade, and recovery were all improving year on year, period on period. So that's all good. If we look just ahead in terms of what's to come in the forecast, we obviously communicated to the market earlier that the Thaba JV ramped up slightly slower than what we anticipated originally. And as I said, I'm going to talk more about that at the end of the presentation, but you can see how the Thaba contributions are starting to come through on the green bars at the top of the profile. So that certainly helps us to maintain our profile, as some of the other plants might see lower grades going forward. But we will obviously assess during our new business planning cycle between April and June how the current grades are performing, and if there are potential upside in 27 and 28 going forward. While we haven't talked much about chrome, both in the results or in these graphs at this stage, we've shipped the first chrome concentrate from Thaba during the period, but it will only become a more significant contributor during the next period. But we have a target of between 60 and 90,000 tons of attributable chrome for this period that we communicated. Just in terms of operational focus areas, it's not surprising, obviously, if we look at the potential that the potential improvement we can have once Thaba is reaching steady state or there's nameplate capacity. Our primary focus for both our operational and technical teams are to make sure we continue to improve the plant throughput rate and stability at Thaba, so that we can get the plant to nameplate capacity, and also focusing on the ROM quality feeding the plant. And I'll deal a bit more about the implications and plans there. And then besides that, is pretty much focusing on the existing dump operations to make sure we maintain the same momentum and discipline that we have seen over basically the last 12 months, that were all record performances for the company, and to ensure that we continue to add attractive value from these operations. I'm going to hand over to Ronel now to just take us through the key financial aspects of the presentation and the results.
Thank you, Jaco, and good afternoon to everyone on the call as well. Not only did Sylvania had an exceptional 6 months performance operationally and in the safety space, as Jaco mentioned, but looking at the profit statement for our half-year results, it is evident that the 6 months ending 31st December 2025 has been a very successful period for the company financially as well. The improvement of the 4E PGM basket price during Q2 had a significant impact on the profitability of the company, and was further supported by the record ounce production for the period from the SDO. Net revenue, which includes byproducts and sales adjustments as a result of the provisional pricing period, increased by 110% compared to the comparative period. And I will explain in the next slide some of the underlying drivers of this revenue increase. Cost of sales includes direct and indirect operating costs, and increased by 31% period on period, including the mineral royalty tax, of which approximately 4% relates to the rand-dollar exchange rate fluctuation. I will also expand in more detail on the cost drivers later on in the presentation. The mineral royalty tax on the attributable ounces increased by $3.7 million. This increase relates mainly to the increase in applied mineral royalty tax rate, driven by the mentioned increase in revenue. Additionally, there was less qualifying deductible capital expenses available during the period. The impairment of exploration and evaluation assets of $12.3 million relates to the Hacra project located in the northern limb of the Bushveld Igneous Complex. During the reporting period, a decision was made not to commit any further additional capital to this project, which resulted in a non-cash impairment loss of $12.3 million. Hacra also forms part of an exploration portfolio acquired historically, where approximately $10.1 million of the purchase price was apportioned to the Hacra project, with an additional exploration spend of approximately $2.2 million to date. Income tax is incurred at the corporate income tax rate in South Africa of 27% on taxable income generated in South Africa. The income tax expense increased from $2.6 million to $13.5 million, and this increase in income tax is mainly as a result of the higher revenue realized, with a proportionate increase in taxable profits. Also included in the income tax expense is deferred tax recognized mainly on capital assets and unredeemed capex. Looking more closely at the revenue for the period, and as shown in the revenue graph on the top left-hand side, the net revenue increased half year on half year by 110%, equating to $52.3 million. 85% of the increase is due to the increase in the average 4E PGM gross basket price, which increased by 55% period on period. 24% of the increase in revenue is due to the record ounce production during the period, which increased by 25%. And lastly, the first chrome revenue was realized through the Thaba JV during the period of $639,000. The pie graph on the top right-hand side indicates that platinum is still the largest contributor to the current 6E PGM revenue stream at 43%, followed by rhodium contributing 33% and palladium contributing 13%. The bottom graph details the increase in the EBITDA from H1 FY 2025 to H1 FY 2026, amounting to $41.12 million. This increase is contributable mainly to the 110% increase in net revenue as mentioned, driven by the 55% increase in metal prices and 25% increase in ounce production. On the cost side, and despite increased revenue as discussed, we continue to focus on disciplined cost and capital management as well. The SDO cash cost per 4E PGM ounce amounted to $726 per ounce, which equates to approximately $570 per 6E PGM ounce. Although the total operating costs were higher than the prior period, the total cost per ounce decreased due to the higher ounce production during the period. The graph on the top right-hand side reflects the chrome cost per ton relating to the Thaba JV. As indicated by the blue bars on the graph, the unit cost calculated on the base case is estimated at $114 per ton for the full year, and then continue to decrease towards 2027 and 2028. Due to a potential adverse impact by lower ROM feed quality from the current pit, a conservative cost per ton was calculated and is indicated by the grey line on the graph, indicating a potential marginal increase in dollars per ton. A detailed mining review and optimisation studies are currently underway, but Jaco will expand on the detail thereof later in the presentation. As reflected in the pie graph at the right bottom corner, as well as in the table on the left, labour cost, electricity and power costs, the buy-in of third-party material, as well as consumables are the top 4 contributors to direct cost. Labour cost remains the highest cost for the operations, and the annual salary increases were effected in July 2025, aligned with prior periods. Power and electricity increased at a rate higher than the South African inflation rate during the period. Although the third-party material constitutes a large portion of the overall cost, it continues to contribute positively and strategically to the group as a whole. This cost is calculated on a price matrix, which is directly linked to the basket price. And therefore, in terms of elevated basket prices, the cost of third-party material increases proportionally. Work in progress relates to PGM ounces and chrome tons produced in the current period, which will only be delivered in the coming periods. Although the all-in sustaining cost and all-in cost increased by 23% and 10% respectively, of which again approximately 4% relates to the rand's appreciation against the dollar, the company remains well within the lower quartile of the cost curve. There has been no major changes in the forecasted capital spend up to FY 2028, and estimates are in line with previous communication. Capital spend for the first 6 months of the financial period amounts to $12.3 million. This excludes attributable stripping cost of approximately $3.7 million, as well as attributable cost capitalized from the Thaba JV during the ramp-up phase of approximately $1.3 million. Capital spend estimated for the full year equates to $30 million and is in line with previous communication. The tailings dams and related infrastructure remains the largest portion of the capital spend, with a remainder of $11.4 million forecasted for H2 FY 2026. Attributable capital spend at the Thaba JV for H2 FY 2026 is estimated at $1.9 million, and included in the exploration asset capital estimated for the remainder of the period is the planned drilling program at Aurora project of approximately $1.1 million, following the geochemical and geophysical surveys already completed. We also continue to exercise disciplined cash management, ensuring optimal capital allocation and balance sheet resilience. Cash inflow from operations during the period amounted to $25.75 million. Net income tax paid across the portfolio to the local tax authority amounted to $6.87 million. Capital cash outflow amounted to $15.72 million, and dividends paid during the period amounted to $6.85 million. We closed off the period with a healthy cash balance of $54 million. Our capital allocation approach is underpinned by strong cash generation and disciplined cost control, enabling us to reinvest in our operations, advance growth initiatives, and deliver sustainable returns to the shareholders. Following Sylvania's strong performance for the period ended 31st December 2025, and in line with the capital allocation framework, we are pleased to declare an interim dividend of 2 pence per ordinary share, which is aligned with our dividend policy. And as Jaco mentioned in the introduction, we have also earmarked approximately $2.5 million for potential share buybacks during the course of Q3. Our history of paying consistent uninterrupted dividends, as well as the aforementioned additional capital allocation, emphasizes the company's commitment to return value to shareholders through both regular dividends and opportunistic share buybacks. Further, there has been no capital raising in the market since December 2009, and we continue to fund our capital expansion and optimization projects from cash reserves. Thank you, Jaco.
Okay. Thank you, Ronel. And now that we have discussed the overview of the past period's performance and demonstrating how we're adding value, I think it's also important to look at just what is in terms of our growth pipeline. And from a growth perspective for the company, we have a two-pronged approach. Firstly, we continuously look at how we can unlock further potential of value from our existing suite of assets, which now also include the Thaba operation that has been just commissioned. And secondly, we are looking how do we create value from external growth opportunities where we can replicate our proving operating model and leverage our successful track record and experience. So before I talk to some of the future opportunities we are exploring, first let me start off by giving you an overview of the current progress on Thaba to date and what our primary focus areas are. I think what is encouraging is that we have now successfully commissioned the Thaba project during Q1 of 2026 financial year. We've had our first chrome and PGM concentrate product dispatched during the past quarter, and that's an important transition, important as we transition from commissioning into commercial production. And then we are continuing with the ramp-up phase and aiming to reach nameplate processing capacity by the end of Q4. I think we had some challenges during the project. I think it is not unexpected for a project this size and complexity, but we certainly thought we would have a faster ramp up than we've had. And there's primarily two areas that contributed to the current ramp up plan. Firstly, from a physical ramp up perspective, the capacity in the plant has been slower than we anticipated, and this was primarily impacted by teething issues with some of the equipment and processing and related to the processing circuit integration as we started up. We also had, starting a new plant up with new people and a new circuit. We had to look at how do we improve the experience quickly, and then some early stage plant configuration optimization also impacted on physical throughput and availability in the plant. And as I said, our technical teams and operational teams have made very good progress and good strides during the past 2 to 3 months. And, I'm very positive with the progress, and that's why I'm confident that we should be able to get to that nameplate processing capacity towards the end of Q4. The second aspect that had an impact on our current ramp up and also has an impact, as I'll illustrate on the next slide, just on the production going forward, is that we've had initial lower ROM feed quality and variability from the host mine. And a lot of that's primarily linked to the early development of a new open pit mine and higher than planned waste dilution that we've experienced than we planned. But we're currently engaging with also our JV partner who is managing the mining, owning the mine and also managing the mining operations, as well as technical mining and geological specialist team that we've appointed to assist with review of the resources, the mining plan and models, and as well as the schedule and procedures, so that we can ensure we optimize the feed to the plant in the period to come, so that we both maximize short-term profits as well as optimize the NPV over the life of the project. So we've commissioned the mining study already in the past quarter, and the review is underway. Some of the initial findings are communicated and implemented as we progress, while the final findings from the optimization studies and detailed reviews is expected during this current period and probably in the next 2 to 3 months. And we will continue to keep the market abreast of developments in that regard. But I think overall, while the initial production was adversely impacted, we still believe that the overall project is key to the long-term future and growth of the group, and will still continue to add attractive revenue and profits over the life of the project. If we just look at, trying to illustrate the impact of the slower ramp up and also the slightly more dilute run of mine, we've included some graphs and sensitivities just to guide investors on that. I think, and we termed on this graph, so you would see this, we talk about the conservative ROM assumptions or the average life of mine assumption. Average life of mine is what we've previously planned, and that in the investment case, and the current conservative ROM is taking into consideration roughly a 10 to 15% additional grade dilution over the years to come. But that obviously have an impact, a knock-on impact on chrome production and also PGM production as we continue. I think what we can see is that while there is a slight impact, we would through optimization efforts end up somewhere between the two lines, and still considering that the project still would add between 10 to 14% EBITDA increase of about 20 to 30% of our overall group material, which is significant. And as I said, we will probably be 10 to 14% lower on chrome product, about 15% lower on PGM ounces for the period. But as I've mentioned earlier, despite this ramp up, we still believe it's an attractive project and will contribute to attractive diversified revenue and EBITDA as we continue. I think what's encouraging is that we understand what the challenges are, what some of the levers are we are able to pull, and I believe that the team would be able to resolve it as we go forward. This is just an update for people who to illustrate, what the site looked like since the commissioning. We have the run-of-mine stockpile and milling circuit up front, the hydro mining station, also the PGM flotation and the milling circuits, and some of the chrome stockpiles with the material dispatched. If we look at the growth outlook, and so I've mentioned already Thaba, and certainly that big part of our growth in 2026 is optimizing and stabilizing the Thaba operation that will continue to contribute. But I want to focus here maybe on the two most significant short to medium term opportunities we are working on. The first one is a pre-feasibility study that's currently underway in terms of a potential new treatment, chrome dump and ROM treatment facility on the eastern limb. That's currently in the pre-feasibility stage, and it's a project that would be probably very similar in nature to what we have done at Thaba, where we would share both a chrome and PGM revenue stream, and probably to the same kind of capital requirement as Thaba. The pre-feasibility study results is expected during probably to be complete during Q4, and we should be able to update the market on our strategy and the outcome during our full year results later in the year. And we will at that stage decide, do we have enough confidence in the pre-feasibility study accuracies, and also is the investment case robust enough that one could consider going straight to execution, or does it warrant us to go first complete a full feasibility study? And the difference between the two would mean that there's about a year in delay if we would do a full feasibility study first. The second project that we're doing pre-feasibility on at the moment is looking at potential fine chrome recovery from dormant chrome tailings facilities, where there's still significant potential value in some of the final tailings dams at our respective mine sites. And that could potentially generate both a additional chrome revenue stream as well as a life extension. But we are still engaging with the host mines in terms of potential terms of that and the outcome of the pre-feasibility, which is also probably due in the next 3 to 6 months, but again guide us in terms of what the best decision is. I think barring these specific projects, then we also continue to look for opportunities that further diversify our commodity profile and operational presence by considering alternative commodities and jurisdictions where we can replicate our proven operating model and leverage our successful track record and expertise. And we frequently perform technical and commercial due diligences on such complementary projects and opportunities that come across our desk. And we'll continue to do so going forward to see how we can best grow the company. I think if we look at the opportunities, also important maybe to consider the market outlook. And I just want to take us through some of the parameters. I think firstly, you have seen in our results already that we've had a significant increase in the PGM price during the previous half year. And I think you can see it on how the individual metal price increased. Obviously, the rally was led by rhodium and platinum. Platinum increased 59% over the past 6 months or half year, and rhodium about 57%, and palladium also holding up nicely, increasing by about 33%. And And also, if I think you consider our pearl split, where we have 65%, or call it 66% platinum in our pearl, about 11% rhodium. Certainly those increases assisted greatly to boost our revenues, as Ronel has illustrated. I think also from a chrome point of view, that bottom graph is just showing that while you normally have the chrome and PGM prices quite counter-cyclical, we're fortunate at the moment they both are at a fairly attractive level at the same time, and the chrome has maintained its momentum in a range of between $260, $280 for the past 6 months, and still remains robust. If we look just before going into the specific supply-demand fundamentals for both PGM and chrome, it's probably worth pausing for a moment to consider the most recent and updated PGM industry cost curve as compiled by Nedbank Corporate Investment Banking. I think what we can see here is that there's been a much needed relief for PGM producers over the past 6 to 12 months, where basically every one of the producers at the moment is profitable, and that's indicated by the gap between the green bars, which is the cost, and the staggered red line at the top, which is the revenue graph. And that certainly is giving the industry a lot of breathing space, especially if you consider that just 12 months ago, and if you look at that dotted line at the bottom that says average basket price February 25, about half the industry was underwater. And still only 6 months ago, about 20 to 30% of the industry was also still loss-making. And that is important to note, because as we talk about the supply constraints and outlook on the next slide, the fact that a lot of the expansion and growth projects in the industry has been put on hold or delayed at last, the period actually leading up to last year this time, and during that period, because so many of the producers were loss-making, you can't just bring those projects back immediately because we've seen a 6 months or a 9-month relief in prices. Most of the producers would want to see a more sustained high price environment before reinvesting or committing as capital to those projects. And finally, just before I move off this graph, Ronel have spoken about us being well positioned within the bottom quartile of the cost curve, and you can just see the blue bar at the left indicating Sylvania's position, well positioned. What that does for us is that when we are in a difficult price environment like the one when I explained in February last year, Sylvania is still able to continue to generate attractive cash and fund our growth aspirations when it's maybe then more difficult for some of our peers. And when we're in a good market environment like we are now, we are able to return attractive value to our shareholders and generate cash to fund our aspirations. So just briefly looking at what's happening on the supply and demand. Obviously, with our pearl split, as I explained earlier, and considering that more than 80% of palladium and more than 90% of rhodium is consumed in auto catalysts, vehicle sales and auto catalysts remain one of the primary focus areas from a demand point of view. But I think if we consider the demand for auto cats and the growth in hybrid electric vehicles and the slower than initially anticipated decline in internal combustion vehicles, combined with some tighter emission standards globally, means that the demand remains strong for auto catalysts, certainly for the near to midterm. I think we all know that the growth, while it's still growing, the pure battery electric vehicles, it is at a reduced rate, and the hybrid electric vehicles still use auto cats, so that's good for the industry. In terms of platinum specifically, besides the auto cat demand that's stable, we've also seen increased demand in jewelry, industrial applications, as well as some of the investment demand during the period. And these are all positive contributors. And if you look to the forward demand applications, future demand applications for platinum as well, in terms of energy transition, the hydrogen economy, certainly platinum has a very strong demand outlook. And in summary, we remain, as a company, retain a robust outlook from a demand perspective in the near to midterm. When we look at supply, and I personally think if we look at the price reaction in the last, in the previous half year, the supply is probably one of the bigger considerations, because I explained earlier that some of the growth projects have been declined. And if you look at the longer term South African production outlook, we know that there's a declining production profile unless new production comes in online. And that combined with very low above ground stock levels, which is still being maintained and at record 5 to 10 year periods for respective metals, that is certainly a big consideration for the market. And while secondary supply from recycling has started to see an improvement and a slight increase as the prices increased, it was not as much as initially anticipated, and it's still quite at subdued levels compared to historic levels. So all in all, if we consider, and looking at the graph on the right, where all three metals are expected to be in deficit for at least 26 and 27. Rhodium is so finely traded, so it's close to balance, but just in deficit. And I think once you get to 28, many analysts still have all three metals then in deficit, or maybe palladium just going in a slight surplus. But certainly that would support the overall PGM price outlook during the next period. And I think we would continue to see stronger prices for this year, and certainly, as we've seen from most of the analysts that's covering our company and also doing some research, that they share the same view. From a chrome perspective and point of view, it is probably a bit simpler in terms of demand than the 4E PGM basket, that in the sense that stainless steel is by far the biggest consumer of ferrochrome production globally. And as I've indicated in those graphs at the bottom, the stainless steel consumption or production have been increasing or growing at about 4 to 6% annual compound growth rate over the past 10 years. It has slowed down slightly to about 3% in 2025, and again to between 2.5% and 3% expected for 2026. But even at the slightly slower growth rate, it still continues to grow, while we see the chrome ore production fairly flat and the ferrochrome production even potentially marginally dropping off. So from supply demand fundamentals there, again, I think it's fair for us to remain and retain a bullish outlook on chrome going forward. And you can see on the chrome prices, the trend at the bottom, both in rand and dollar terms, it has been trading in a good range for us during the past 6 months. I'm going to hand back to Ronel to just talk us through some of our ESG highlights before I will close off in the presentation. Thank you, Ronel.
Thank you, Jaco. I think as a retreatment-focused mining company, sustainability is already inherent in our business model, but we continue to prioritize environmental stewardship, social responsibility, and the safety and well-being of our people, as well as the strong governance to deliver resilient and responsible operations. On the environmental side, the tailings facilities management remains key, and we continue to conduct regular inspections aligned with the global industry standard and tailing management standards, and no material risks were identified. Additionally, slope rehabilitation trials are in the planning phase to expand on the positive ecological responses that we've seen during the previous trial at the Tweefontein operations as well. We are also very proud of our industry-leading safety performance, with 0 fatalities since commencing operations, as well as 0 LTIs reporting across all operations during the current period. The communities in which we operate remain important to us, and we funded the installation of a solar power system at the Modderspruit Medical Community Clinic to enable safe and uninterrupted medical care to the community. The table on the left-hand side indicates the various financial contributions made to employees, the local tax authority, as well as suppliers, which include suppliers from the local community in which we operate. And back to Jaco now to take us through the outlook.
Thank you, Ronel. I think if we just look at the the current year. We spoke quite a bit about what's happening at Thaba, and that certainly is going to be a big focus area for us carrying forward. And you can see, especially as we go into the next year, the improvement, or as the Thaba contributions from chrome and these PGMs come in, our EBITDA increase. But besides Thaba that we're focusing on, we will continue to focus on our SDO operations to make sure we continue the strong performance during Q2, where you have a production target of 90 to 93,000 ounces for the full financial year, which together with sustained PGM metal prices would assist to post significantly improved EBITDA for the year. And if we look at based on our current price assumptions, that just for information also equate to about $2,400 per ounce is what we've used in these solid bars, then we would see a full year EBITDA increase by more than 300% to approximately $97 million for the 26 financial year. And that would improve to a range between, to approximately $116 million in 28 as we start getting a stable Thaba contribution in it. So overall, I think I said earlier, we're quite bullish about the PGM prices at the moment. We're very confident with both the existing operations performance and how that has been doing over the years, and also the momentum carried into this current half year. And also we are happy with the efforts and the measures taken at Thaba to improve the ramp up. So overall, a very positive outlook for the remainder of the year, and I'm hoping that we can share some exciting results with you at the end of the year when we do our full year reporting. So just in closing, I think our shareholders would agree that Sylvania remains an attractive, low cost, low risk and cash generative business. And over the years, we've developed a track record of strong performance, and I think we've proven that we continue to deliver significant, or return certainly significant value to our shareholders over the years. And while we still have some significant expansion planned for this next year and a little bit in the following, as Ronel has indicated, we will continue to prioritize our capital returns to our shareholders alongside the value creation and the business sustaining requirements going forward. So yeah, that concludes our presentation, and I would hand back to Alex at this point.
That's great. Thank you very much, Jaco Ronel, for your presentation. I will now turn your cameras back on. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. Jaco Ronel, at this point, if I may just hand back to you to take us through the Q&A session, and I'll pick up from you both at the end. Thank you.
Thank you, Alex. So I was just looking at the side of my screen on some of the questions, and we had one of the pre-submitted questions that were asking us about some of the criteria we would use in terms of investment and how when we look at capital employment and investing in projects. I think what's important, and we have communicated that some of our previous discussions, with our big focus of being low risk, cash generative and low cost operator, we obviously look at projects that meet that criteria as well. So from a board perspective, we certainly try and only do projects where we have a IRR in excess of at least 20% as one of the criteria. Then also considering the market fundamentals and aligning with our strategy. We ideally want to invest in projects that have a simple payback of between 3 and 5 years. I think that reduce your risk significantly. So those are just some of the primary measures that we look at. One of the other questions, I think it was Preston from Ireland, said, I came across a mineral called osmium, which is only found when mining platinum. Price per kilo is over £1 million per kilo. So does Sylvania Platinum ever find this extremely rare mineral? Thanks. I think osmium is occurring in the basket with PGMs in the Bushveld complex in South Africa. However, because of the low, it's in trace quantities and the low quantity, it does not typically form part of the revenue basket for junior material companies. You would find that the majors your Valterra, Impala, Novum, or Sylvania might record osmium revenues because they can recover in refineries that, and with the higher volumes they're treating, it is easier. But typically, so certainly Sylvania does not have exposure to that. And as I said, as far as I'm aware, very few, or if any, of the mid-tier or junior producers would have access to that revenue. I look at the next question. It says on the Thaba JV, and sorry, this writing is small. I'm just going to put my glasses on. On the Thaba JV, please can you help us understand the cash flow dynamics? How much have you invested so far in terms of capex, shareholder loans, and working capital support? And what should we expect in terms of further cash contributions from this point? And how should we expect cash to be returned from Thaba? Will the working capital loan be repaid in 27? And should we expect dividends to be passed up to all the shareholder loan to be consistently repaid? How should we think about the cash conversion of Thaba? So I think, if I go just back to the Thaba slide, what we have said, and I must maybe just correct. So the capital for Thaba at the moment, the overall project capital was about $58 million is the project capital. That excludes, I think, the stripping cost that has been capitalized, but that's also getting added back as we remine the pit as on an ongoing basis. So it's about $58 million on the project side. We still on the fundamentals, and if you look even at the conservative case, still between a 3 and a 4 year payback period based on the current price assumptions. I think the rules in terms of our JV agreement stipulation, we have communicated that before in the market when we announced the project, is that the loan repayment would commence on the first anniversary of the commissioning, which would be in the second quarter of the next financial year, in quarterly payments over a 5-year period. So that is certainly how it would be repaid. The question in terms of if we would pass up dividends while we are waiting for this loan, certainly I think just our current dividend declaration is illustrating our good commitment not to do that. We have, as our dividend policy says, we would pay a minimum of 40% of our adjusted free cash flow. And the adjusted free cash flow would obviously take into account what we funded now in terms of Thaba. It takes into account the capital we are currently employing on our other stay in business and growth projects. So if you would take that into account, we have the 2 pence dividend declared for the current period is well in excess of the 40% of adjusted free cash flow. So, and that was specifically the decision of the board to do that in order not to penalize shareholders for the flow of the funds in terms of the Thaba agreement. I think that's in line with our overall capital commitment and also considering the level of cash that we need to maintain to fund both continuous shareholder returns as well as strategic growth projects. So I hope that answered that question. Then I have a question that says, what's the current 4E and 6E basket price and what's the forecast budget for 26? Previously, I believe was about $1,800 for 4E for 26. I think we explained that the solid bars, I said it in that last EBITDA slide, is our price assumption there is about $2,430. That was based on the December average spot price we received. So about $2,430. If I look at the various forecasts and at the back of our slide deck, and I can maybe go there on slide 38, we have included the sensitivities or some of the forecasts from both Pan Liberum, who's and Berenberg, who are our joint brokers, as well as is it Netbank or the company consensus pricing, and you would see that is still well aligned with that $2,400. And then going into, if I look at 27, 28 forecast on the respective models, would range somewhere between 2,400. Say 2,200 at the lower end to 2,600, almost $2,700 per ounce looking forward in that range. But you can find it in the back of the slide deck. I think, if we look at what rhodium have just done this week, we currently, as it stands on our pearl split, the basket price is at about $3,000 per ounce. So we continue to maintain a sensible and cautious approach to the pricing. And we bear that in mind in the decisions we take. I'm looking at one of the next questions. Given the strong cash balance and likely good cash generation in 26, please can you discuss why you are not buying shares back more aggressively, and how would you consider buybacks and dividends? I think we, again, have mentioned, and Ronel said in her presentation, how we maintain a balance between divvy and share buybacks. I've also, maybe just important to know, to note, as I've showed on that net bank curve, how we moved in a year across the industry average basket price from last year. This time was just over 20,000, say 23,000 rand an ounce. 6 months later, we had 32,000 rand an ounce, and by December, or now at just over 43,000 rand an ounce. So if you put it in rand terms now, that graph unfortunately was rand terms. So you could see that the price more than doubled in just a year. We saw after 21, 22, the buoyant PGM price we had then, how quickly those prices dropped. So you can have swings within 6 to 12 months in this basket price either way. So the company needs to take a risk-based approach to those volatility and fluctuations, and make sure that we buffer the business against that. However, our dividend and the general cash allocation scheme does take the full year into account. So while we've made an estimate now of what we believe the full year free cash flow would be when we declared the 2 pence dividend, at the end of the year we would reassess the position based on the actual free cash flow for the year. And if the metal prices then were maintained and the production levels were maintained, we by all means would adjust our allocation at that point. And as I said, we have announced already that we've allocated $2.5 million for the shares, share buyback. I think on Ronel's slide, she had the total number of shares bought back. I don't think she mentioned the figure, but over the last 10 to 15 years, Sylvania bought back and cancelled about 10% of our issued share capital. So I think certainly shows our commitment towards share buybacks. Another question is saying, assuming the PFS for the Eastern Limb is positive to the extent that the DFS is not required, what would you be looking at in terms of potential timelines for the construction production? Yes, what we see there is obviously it is a greenfield site. So if we can go straight to execution, and as I said, the level of confidence is high enough that it warrants us, you can continue straight. It would be between say a 24 and 30 months timeline, because the bottleneck or on the critical path there is environmental authorizations for the new tailings dam on site that have to be there. There's some power infrastructure that we have secured but still have to be installed. So I would say our current estimates is probably about 24 to 30 months from when we make the decision, but that final timeline will be confirmed once the PFS is published. Would you consider, so this is the next question, would you consider a move to the UK main market and leave AIM? I think that's a question it's not the first time we get posted. I think, certainly we understand there are some benefits to that, but I think Ronel mentioned that the last time we raised capital in the market was probably in 2009. And we continue to look at growth and expansion projects. I think the right time, considering the high cost of and the logistics of moving from the AIM to the main market, would be if there's a substantial M&A transaction or something to do that. So it's something that we don't have any immediate plans, but continuously on our radar, and we will continue to assess the merits of it as we continue. Then there's just a question that says, Pandora announced a switch from silver to platinum. Is there enough platinum in the market to support this change? So yeah, I know that there's been significant increase in demand in platinum in the Chinese market during the course of last year because of the price differential between gold and platinum, and that has taken, I think the guys have been talking about on the upside of 1 million ounces of platinum. They're benefiting from that move and that demand, but I can't, unfortunately, I don't have any idea of how much Pandora has in terms of what their typical silver consumption is. I certainly think that the supply, probably the current forecast did not take that necessarily into account, so there could be upside, but I would not be able unfortunately, give an opinion on exactly what that would be. I have another question here that says, great position on PGM pricing, but a little disappointing on slower startup and more dilute ROM from Thaba for chrome. The JV partner no doubt learned some lessons, but was this linked to shortcomings in the modeling? Or was the drilling perhaps a bit too spaced out? And so on. So I think, as I said, we're currently reviewing the model. We obviously have concluded or done a due diligence study on the mining plan, also a part of the problem. I think if I look, and the current indication probably is we underestimated the amount of stripping dilution, as said, from the initial operations. If you in hindsight look like we had a flatter profile in our planning initially, rather looking at averaging it out on over a year and years than looking at the specific ramp-up profile. So I think there are some lessons learned there for us in that. I think with the engagement of the specialist mining consultants that we've employed now as well, together with the staff from our JV partner, we I think have a good handle now and reviewing the models to just identify where the dilution is coming from, what kind of levels is acceptable from industry standard, and how can we optimize the current mining operation to achieve that. So, as I said, we at this stage don't believe there's a fatal flaw in anything identified. I think it's probably more a scheduling issue. And if we look at if there's a longer term impact of the overall dilution, the sensitivities I've provided in the graph does indicate that on the Thaba slide. And as I said, still, even if you take that into account, Thaba would be an attractive revenue and profit contributor to the group. So then there's a question that says, given the surge in the PGM basket, even since the reporting period end, what is SLP's strategy in terms of hedging? So I think, to give me a chance to take some water, I'm going to give that one to Ronel to answer.
Yeah, I think historically we haven't hedged. We've had quite good results just continuing without hedging. And I think the feeling also is that if we did, for example, hedge during the COVID time where rhodium had the spike and the runaway, we might have lost out if we locked in the prices there. So we do continue just to keep a close eye on the prices and the volatility in the market. We also partner quite closely with treasury advisors who advise us on the movement of the market. And we continuously actually engage with them to advise us whether we should consider hedging or not. But at the moment, and again, it's one of those things that we haven't written off. We continuously consider it. But at the moment, we are continuing as we are.
Thank you, Ronel. Finally, just the last question, and I'm conscious of us running out of time as well. But there is only one question left, and it says, great presentation, but why not mention of the high value loan to the Thaba JV partner? What is the value of this loan currently? I'm again going to hand back to Ronel just for the values, but it is obviously included in our financials that has been included in our interim report, also released yesterday. But also maybe just mentioning that if somebody is not aware that loan has been granted on as an interest-bearing loan at South African prime interest rate that's currently 10.25%. So that is also just worth mentioning. But Ronel, you can probably just give us some indication of where the project capital loan sits at the moment.
So the project capital loan currently amounts to $30.5 million. And as Jaco mentioned earlier, in terms of the payment terms as well, it is repayable on the first anniversary of commissioning date, which will be in Q2, and that is inclusive of the interest as well. And we have constant communication with the JV partner as well in terms of the repayment of that related loan.
Thank you. Alex, I think that concludes the questions that we've had.
So, yeah, that is correct, Jaco. Thank you for addressing those questions from investors today. But Jaco, before we direct investors to provide you with their feedback, which I know is very important to you, could I please just ask you for a few closing comments?
Thank you. I think, maybe just in conclusion, I'm very pleased with the Sylvania's performance over this past financial period, both from a production and financial point of view. And I'm very excited about the future and the growth prospects of the company. As I said, we have a short-term disruption or slower ramp up at Thaba, but we still remain confident that the long-term value will be realized as we ramp up. So, I believe that as we have continued to demonstrate both through our performance and our solid result over the years, we, Sylvania as a company, and we as a group remain an attractive, reputable, stable cash generative company that I think we have illustrated that we can continue to return attractive value to shareholders through both stable dividends and share buybacks, and by also establishing ourselves as a partner of choice in the industry. And I'm sure we would be able to continue doing this going forward. So thank you for everybody who attended the presentation, for all our shareholders for their support over time, and we look forward to continue the journey with you. Thank you very much.
Fantastic. Thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback, which will help the company better understand your views and expectations. On behalf of the management team, we would like to thank you for attending today's presentation, and good afternoon to you all.